Hello and welcome to the first video form of the Delta Grain Marketing Harvest Outlook. In this bulletin, I just wanted to give you a rundown of where the market is for the harvest period, looking at wheat, barley, canola and chickpeas. If we start with the wheat market, as we've been discussing over the last many months, clearly we've got the biggest drought we've had for probably 100 years on the East Coast, with very unusual to see Queensland, New South Wales and Victoria all suffering drought at the same time. It really hasn't happened this poorly since 1902. And we've had many months where we've had a record dry for June, July, August and September in many areas. Obviously, the New South Wales crop is going to be less than 1.5 million tonnes. The average wheat crop is 6 million tonnes, and in 2016 we had 10 or so million tonnes. So see, it's a really serious situation, and also in Queensland it's about 500,000 tonnes, and they're going to need about 2 million tonnes for their feed requirements for all their feedlots. And so there's been obviously a huge export program going over the previous 3 or 4 months from South Australia and WA, and that's going to continue until October next year with the new crop 2019. Clearly there's those numbers that we're looking at from WA. Currently they've got a track number of about, delivered port number of about 355 for APW, about 330 or so for F1 barley, and about 355 or so for malt barley, so just slightly better than wheat for the malt barley, is almost 360 actually. So that's really it costs about $35 to bring it round, and then there's by the time you get it off the vessel onto a truck and up country, you're talking about $110 or so from the port price there to land it up country in New South Wales. And when you're thinking about moving 4 or 5 million tonnes from WA to New South Wales over the next 12 months, really that sets the underlying base price for grain. As we see it, we see a few soft cash sellers at harvest time, which will be pushing down the price of the ex-farm and delivered in the very short term. But I expect that only last 4 weeks, maybe 2 months at the outside. And by the time you get into early January, I think those soft sellers will be long gone. It'll start to get hot, and people will start to think about where they're getting their local grain from, and it's 2,500 kilometres to the biggest supplier. So we see that sort of number at 440 delivered up country as being the base price of wheat for the next 12 months. Clearly there's a little bit of movement that can be had if the WA grower is very aggressive on his sales. Then we're watching the WA price daily to see what happens there, but we don't expect a huge amount of pressure from there. There's only barely $10 to an export parity price into Malaysia or Indonesia, so we can't afford WA to fall much further. And really the only other thing that could really erode us is if the US futures fall further, and really that looks reasonably unlikely at this stage of the game, given that Russia's been front-loading their export program, and US has been missing a lot of early sales. They're currently down about 22% on what the USDA thought they would be. But once Russia starts to dry up in what's expected to be very early 2019, then the US should really get the lion's share of export sales from there through to June, and that should really pick those guys back up. And with the minimum price scheme going on with with the government guaranteeing a minimum for the US grower. They just don't feel fear or panic like we do here, and they seem to be very happy to just not sell and hold. So the price has been extraordinarily calm and really been barely moving in a 25-cent range, about around 510 cents a bushel in the US futures in December for the last 2 months. Been staggeringly calm and quiet, and by the same token, our currency has been very steady, around 71 cents plus or minus a cent. So that's made pricing very easy, and it's made the calculations from WA to northern New South Wales and Queensland very easy too. So that's sort of where we're at in terms of the big picture of what we're facing. And in terms of local supply, we think there's about 1.5 million crop coming out of New South Wales and 500,000 in Queensland. We really question how much of that 1.5 million tonnes is going to flow through to the bulk handler. And so given that the price is really a feed-driven market and most of it's got to come up country, then this year track numbers are pretty meaningless. And really the value is seen is the delivered and ex-farm market. And Delta Grain Marketing specialise in watching these markets, in trading these markets, and we've got strategic alliances with the buyers of grain from WA and the importers, and so we've been had a lot of success in helping graziers find grain over the last 6 months, and we continue to feel that as our focus for the next 6 or 12 months, and also helping our grower clients who have been lucky enough to grow some grain to find the best numbers we possibly can, whether that's ex-farm delivered into the feeders, or for delivering into the packers for some small box trade. There's some interest from millers in the milling grade wheat, so H2 and above. They'll make sure that they are ahead of the feed market, and certainly they'll be looking to buy over the next 8 weeks, and we'll be looking to make them pay as much as we possibly can get out of them to keep it away from the feeder, and also some box trade into our Asian neighbours who have been really price elastic and demand. They keep buying. Certainly Japan, Korea and Vietnam are very, very keen and buy it no matter what, whereas Indonesia and Malaysia are certainly more circumspect about. They're more price driven, and so they mix it up but they won't be buying any East Coast grain, that's for sure. So that wraps up, I think, wheat. Moving on to canola. Canola's a very interesting marketplace, really. The international price picture has been quite subdued. As a chartist, the Canadian and French canola price action has been pretty ordinary over the last few months, and we're seeing that price look quite heavy. Clearly we've got a teensy tiny crop in New South Wales, and we've seen up to 85% of the crop in southern New South Wales being cut for hay in the last few weeks, and it's really going to be a record small crop for New South Wales. However, last year the local crushers were forced to buy canola from Victoria, South Australia, and to a lesser extent WA, and for the 600,000 odd tonnes that they need, they were able to get that pretty easily and reasonably efficiently, and they've certainly been looking from way back in May, June, they were looking to do that, and we see that as being ongoing. We therefore think that even though the East Coast crop is small, we think that a lot of the small crop has been priced in. basis is quite strong, and at $650 odd track, it's a reasonable sort of level, historically strong, absolutely. But if it was mirroring the type of strength we're seeing in wheat, then we'd be well over $700, but we're not. And conditions are well known and well understood. South Australia's got a reasonable canola crop. Victoria, not so great, because it's really only the bottom half of Victoria that's got any sort of reasonable canola at all, and there is some frost damage again, and there will be some grain out of some canola coming out of WA. Estimated national crops about 2 million tonnes, so we'll have an exportable surplus, and we are not expecting a big rush in prices. But certainly we would be waiting to see exactly what we've got, what you've got, and what the oils are like and so on before we'd make any decisions at all about marketing. So that sort of covers canola. Moving on to barley. Barley's an interesting one. They've tried to mark barley down, and barley's trading at very low levels in Victoria and southern New South Wales at something as a discount as heavy as $60 under wheat for new crop and the indicative prices, and it's just not reflected internationally or domestically that barley prices belong anywhere near that sort of number. In fact, as I said to you early in the introduction, that malt barley is trading at $5 over APW wheat in Western Australia. It's showing some nice premiums in southern New South Wales of about $30, I think, and northern New South Wales at $10 over F1 barley, but then F1 barley hasn't fallen anything like as much, and it's trading currently about $10 under APW wheat in northern New South Wales and southern Queensland. So we think that barley will close the gap on wheat very quickly into early New Year, and we would be holding barley in southern New South Wales and certainly not selling that. Much of it, of course, will be staying on farm, building stocks, filling silos. Lots of people have big programs of feeding wheat and lambs particularly. Lamb prices remain very, very strong, and we see that as being an ongoing demand issue. We're getting too late in the season to build big feed volumes in southern New South Wales and Victoria. It's getting too late in the season. They should be at peak feed in paddocks at the moment, and they've got very, very poor pasture conditions. So a big feed program lining up for the next 6 months, or certainly until the end of March, and we foresee strong demand there and tiny supply. So certainly we're not sellers of barley in those sorts of numbers, and we'd be looking to sell barley at 10 under APW, and then probably going over APW as we get later in the season. And typically those barley prices build right through to about June, when they often max out at sort of evens to 20 over APW wheat. And so that's the barley situation, and we'd be certainly chasing some good premiums for malt. But please call the Delta Grain team when you've got it off and in the bin, and we'll chase down the price as best we can. So last but not least is chickpeas. Well, probably least actually, because it's such a teensy tiny crop. Typically I think the 10-year average crop yield, national crop yield for chickpeas is about 600,000 tonnes. It maxed in 2016 2.3 million tonnes, of which we exported about 2.2 million tonnes. There was some carryover. And this year we expect a crop of somewhere like 150,000 tonnes. Fortunately, it's probably the best year ever to have India out of the market, with an import ban for India, and national elections not until May of 2019. They're having a dry time at the moment, and they've had 2 limit up sessions in the last couple of days. They're up 4% for 2 nights in a row in India. Prices are very low because they're not able to export and they're not able to import. The government chose to lock down the market, hoping to drive up the prices, but actually last year's crop was quite big. They had more than 1 million tonne carryover, and they really had some to sell, but they've not been able to, so they're thinking that the authorities are likely to ease their embargo and allow them to export grain, export peas into Bangladesh and Pakistan, their traditional sellers. We've been selling bits of old crop to those 2 markets. It's been tough going, and mostly in boxes, and so tough times for chickpeas. We'd be selling it here actually at 800 or 810 delivered, 810 track CQ, 810 delivered Darling Downs. Old crops trading around that 740 track level. So at a discount, Bangladesh has been starting to buy that. It's lifted about $40 a tonne in the last week or so. And again, would be sellers of old crop and cautious sellers of new crop once you know what you've got. I think it's just going to be a long, hard slog until sometime in mid next year before the Indians come back in. They may come back in earlier, but we can only play the balls we face, and we think that there's little reason to think that conditions are going to change in the short term on chickpeas. But we do think if this dry weather continues in India for this big rabi crop that they're supposed to be putting in, then the outlook for 2019 chickpea harvest is very strong indeed. And given that you need heavy rates to plant, we'd be thinking that it's worth holding back some, certainly for the new crop. So I think that's about it for now. Just in a brief wrap up, we think that there's minimal downside on wheat values. Basically, it's a 440 track at the moment, delivered up country for WA wheat, and we see that as the minimum. We can see some strength in a little bit of premium for protein. Domestic millers will be active at harvest time, and there's also some interest from Asian millers for their soft, white, fluffy buns. They really need APH too, so they'll be buyers of that. And for barley, we think be cautious and hold that. If you're not getting something like SFW1, APW sort of prices, then we'd be holding that for absolute sure. We see a build-up of grain domestically on the east coast, and a lot of grain won't make it to the market. So even if we do grow a 1.5 million tonne wheat crop, we don't think a lot of that will make it to the bulk handler anyway. And we see canola and chickpeas as being price limited to the upside, and we'd be selling what you have once you know what you've got. But certainly at this stage we can't see a big lift in those values. There may be some lift in canola, given that it's going to be so tiny in New South Wales, southern New South Wales, but that's how we sort of see it. So obviously it's a day-by-day proposition once you get the grain in and off. Please call us for any questions about value. We're here. It's relatively quiet, but we seem to be busy day on day, just trying to help our clients make the best of what they have. And certainly we're active in trying to, in buying grain for graziers and keeping that going, and will do so for the next, for the foreseeable future. So thank you for your time. I hope it didn't drag on too long, and we'll talk to you very soon. Please don't be a stranger and call us.